Good morning, everyone. Welcome to this update for global stock markets and commodities for the 5th of June. Markets were running along quite calmly until the US jobs report on Friday night, and that was an absolute shocker. We saw the US dollar fall very quickly. Precious metals went up massively, and so it really brings into question whether we've now seen the end of this correction. Frankly, I was expecting it to last a little longer based on what you would typically see, and that may still play out. But certainly the gains on Friday night were absolutely massive. So let's have a look at the action from last week. American stocks finished the week exactly where they started at 2099. And so that didn't tell us very much. The jobs report in the US was terrible. Really, there's no other way to describe it. And initially, stocks were down by a little over 1%, but they did manage to fight back from that and probably regained about 70% of the loss, which was impressive, and just continues what I've been saying over recent weeks, and that is that there is definitely an upside bias to this market, irrespective of what you think about valuations or about where the market should go, given all the negatives that are out there. The fact is, the market really wants to go up, and that was pretty evident again on Friday night. Now, the US dollar was smacked down very hard. It was down 1.8%, which is a huge move for a currency in a single session. And to my mind, I've been turning this over all weekend. The jobs number on Friday night was probably just too bad to be true. So I'm fully expecting that we're going to see the next, the June period, probably considerably better. And also we may even see a readjustment, as the Americans tend to do, to that May number, because it really was terrible. However, in the data, if you look at a lot of the detail of the data, there certainly is cause for concern in there that the US recovery certainly is not doing as well as people thought it had, and so that really now does raise the question about the US Fed being able to raise interest rates at all. So that really now, to my mind, has become the big wild card. People were thinking it was quite likely in either June or July, but I think this now probably makes it quite unlikely until some better data comes through. Now, stocks remain fairly positive. We're seeing, and this is really speaking about the week as a whole, semiconductors moved higher, which is a very positive thing. Financials moved higher, which is a very positive thing, even though they certainly did backtrack a little bit on Friday night. And also small caps in general are in a strong uptrend. The Russell 2000 is looking very, very strong. So these are all real positives for stocks in general. So I'm not too concerned about the jobs report from that perspective in the short term. So if we look at the American market, technically there are supports at 2085 and 2070, so they're not that far away. And we've got resistance at just over 2100, and of course the all-time highs at 2130. So the market remains within that extremely tight range. Now the question is, will the Fed raise rates given this jobs data? And I guess no one knows the answer to that, perhaps not even them at this stage. But it's looking harder to justify on the basis of the economy, because that jobs number really does raise a whole bunch of question marks. So from my perspective, the Fed may still raise in June or July. Probably not June now, I would think. And given that the fact that we've got the British referendum on leaving the euro the following week, I think that the Fed is highly unlikely to go in June, but they may still go in July. But if they do, it'll be about positioning, I believe. I think they're itching to raise rates just so they can have the ability to cut rates again if things look a bit ugly. I don't think this is going to set a trend, and I think what they talked about 6 or 12 months ago of having a whole series of rate increases to get back to normal. I think that's just an absolute pipe dream. So if there is a rate rise, I think it's really just it's a bit political. It's about positioning, and perhaps it's a bit about their credibility as well. So what does that mean for gold and for stocks? Well, in the short term anyway, it's certainly put downward pressure on the US dollar, massive reversal in the US dollar. And of course, that means an upward pressure on gold in US dollars. And hence, gold stocks did incredibly well. Now, if there's a 2000, and if this economic data does lead to a 2017 recession, and I'm not saying that it will, but if it does head in that direction, then that would be very bad for current stock valuations, because valuations in America are predicated on the fact that the economy is getting better and the stock market is looking 6 to 9 months ahead, and that's what's being priced into stocks. So if we are heading into a recession, then all bets are off on those current stock valuations, because they are implying that there will be some good growth in earnings, something of the order of 12 to 14%. So if that jobs data is real, then there's no way that that 12 to 14% earnings growth is going to happen, and that means current stock valuations are probably 15 to 20% overvalued. So that would be a significant fall in the stock market. Now, let me just reiterate, I'm not saying or predicting that's going to be the outcome. I'm just pointing out that if the economic data does continue on its current track, then that's the way that we should be starting to think about 2017. Now, as you know, I love to have a dig at central bankers, and here we have the heads of the Bank of Japan, the ECB, and of course the Fed, and they're all toasting their currency over a campfire, and that's pretty much what their policies are doing. They're really destroying their currencies. You know, they can make any other story up that they like, but that's the net effect. The reason that people aren't jumping up and down about it is because it's a thing that happens by stealth. Gradually, year by year, your purchasing power gets decreased little bit by little bit. It's a bit like putting a frog in cold water and slowly raising the temperature, and that's what central bankers are doing to currencies around the world. So I think that deserves to be appreciated. Let's have a look now at the price action. So there's the S&P index on a big picture level. That's a monthly. Each candle there is a monthly candle. This goes back to 1998 on the far left-hand side. So it shows you the peaks in 2000 and late 2007. And of course, it then just shows you the extent of this extraordinary bull market that's come out of the GFC. We did have a change in character here, which started in August of last year. We did get the start of a sell-off, but the market has quickly regained all that. And as I indicated earlier, the tendency is definitely to the upside. Let's zero in on that a little bit more and look at a daily chart, so you can see we're now in this quite tight range. There's a range between 2020 and the all-time highs, but of late we've really been just oscillating around in this very, very tight range, with certainly 20 around about there, around 2070 as being a bottom part to it, and around 2085 as being the very short-term support. At the moment, if I had to toss a coin, I would say that the market is probably going to break to new highs above 2130. But look, really, I don't have an opinion. Certainly don't have a strong opinion, not one that influences my trading. And I just continue to do what I've been talking about for a long time, and that's just work with what the market shows you it's doing, rather than trying to predict where the market's going to go. That's a pretty dumb game to play. Now, just looking at the US dollar, there you can see the extent of the massive fall on Friday night. We'd come down to this key support at 92 that I've been talking about over the last few weeks. We bounced very strongly off that. As you can see, the size of some of these candles, the rate of ascent, That was a very, very strong rebound, but it's just been absolutely stopped dead in its tracks on Friday night by that jobs number. So, look, I need to see a couple more days of action. I want to see if this follows through, if the US dollar keeps being sold, and if gold, as a consequence of that, keeps going up. Quite often we see traders with one massive reaction to a piece of data, and then when people have a chance to kick back and think about it, they start to soften their position. So let's see what happens over the next 24, 48 hours. Now, the impact of that on the Australian dollar was to cause a significant jump in the Australian dollar. We're back above 73 again, even though we were trending down. So again, we'll just have to see what impact that has. It's one data point at the moment. There wasn't particularly high volume behind it, so let's see how that plays out. Turning to the Australian market, as I said, the dollar rebounded to 73.5. Our index was down by 87 points on the week, and the barrier at 5,400 points continues to hold in the Australian market. Not that I really pay much attention to the value of the index. It's just a reflection of what the banks and the major miners are doing. Doesn't tell you much else. But that 5,400 point barrier is proving very difficult to move through. And it just raises the question whether the weakness in our banks, I know our economy's not great, and there certainly are some headwinds for the banks. So I think they deserve to fall, but I reckon there's probably been a renewed burst of overseas selling of our banks, thanks to the Australian dollar going down. Now, with this big turnaround in currencies, it'd be interesting to see what happens to our banks on Monday. Precious metals, gold was higher by $32 on the week, and basically all of that occurred on Friday night. And that gain in gold exceeded the currency drop. Now, as I said, I want to have a look at the next 24, 48 hours to see what happens. But the negative interest rates is just one of several factors that are driving a return into gold. The major players, the really smart big money, is increasingly moving back into gold, and there's a number of things driving that, and it's largely around central bank policy, and it's almost impossible to see them reversing that policy, and if they do, I think the consequences would be severe, both in the bond market and in the stock market. So that's why I don't think they're going to do it. And if they don't do it, then I think there's going to be a continued move towards gold. And that's why I'm so positive on gold, because I really just can't see any other scenario. To be frank, I think central banks are really stuck. And it's just it's hard to see an alternative. Now, precious metal stocks, the rises on Friday night were huge, between 8 and 14% in a single session, and we're talking some of the world's biggest stocks, biggest gold stocks. Barrick and Newmont, which are the world's number one and number two stocks, jumped by 12% and 11% respectively. There's something massive going on when you see the biggest players in the world jumping 11, 12% in a session. So far, the correction that we've had has been quite mild and quite orderly, which I've been pointing to. And up until Friday night, I would have said, look, you've got to give it a bit more time. June is traditionally the weakest month of the year. Typically, corrections take between 4 and 10 weeks to play out in a corrective phase in a gold bull market. So I would have said, no, the correction still had further run. But now with this massive turnaround on Friday night, it's a much more difficult question to answer now. So again, I want to see a bit more price action. So just turning to this is just a little bit of speculation here on my part by looking at what's happening in the futures market as well as what's happening in the physical market. I think the likely short-term direction is going to be dictated by what's happening in speculative futures. And the speculative positioning in the futures market at the moment, to me, is pointing towards an early end to the correction, that it won't take the normal 4 to 10 weeks to play out. It's been running now for 2 or 3 weeks. It could almost be done. That's what the speculative positioning is suggesting to me, because the long contracts a lot had been shut down, but normally you would see a lot of those people that had been speculatively long on gold immediately switch over and be short sellers. But there was hardly any increase in the short selling interest, which means that people don't have the confidence to go short, which means that they're seeing gold as being on a much more positive trajectory. However, I might add that changes in the speculative futures market, they can turn on a dime. So I'm not hanging my hat on that by any stretch of the imagination. Look, I think it all gets down to the Fed. The Fed meeting on the 15th, and whether they raise rates and what they say about future rates, I think is the biggest short-term driver of the price of gold. And I stress that's short-term. I believe longer-term, there's virtually no doubt in my mind about where gold's going. But in the very short term, the next few weeks, I think it really does depend a lot on the Fed. And what is driving the Fed in terms of their decision? It's really hard to see that or conclude that they're following a path that's in any way consistent or logical. So I think it's a lot about their credibility, because their credibility is what's holding the whole world's financial system together, collectively central banks. And if their credibility starts to crumble, then that's when the whole monetary system gets called into question. So I think they're concerned as much about their credibility as they are for the economy. So this decision may not be what is logically correct for the economy. The Fed has said they're going to raise rates. I think if they don't do it, it's going to puncture their credibility yet again. Yet I'm not sure they can do it. So they really are skating on very, very thin ice. So let's take a look at gold. I missed out on looking at the Australian index. So just for the record, there's the Aussie index. There's the 5,400 level that it's finding difficulty getting through, all these peaks through here. Hard to know what our market might do on Monday. I've got a feeling our market might go up on Monday, given the late recovery in the US market, even though it finished down. Let's look at gold now. There's gold on a weekly basis. It doesn't look all that big on a big picture view, but you've got to say that we haven't had very much of a retracement yet. If we put a Fibonacci retracement scale on here, you can see we just made it back to the 38.2. So gold has done a traditional 38.2% retracement, which is good, and we may well be off again to the upside. Looking at this now on a daily chart, you can see just how big that move was in the gold price on Friday night. The key will be how well it follows through. Let's look at silver. Silver also up appreciably on Friday night, and is pretty much mimicking what's going on in gold. Now let's look at the GDX index, and this was big. As you can see, huge gap from around 2260, opened at just over 24 and finished up at 25.33, and you can see significant volume in the GDX ETF. Let's look at the junior gold miners. Same pattern, even bigger volume spike in GDX. So clearly traders are comfortable piling into the small stocks as well. This was not just about the big guys. Turning now to other commodities, copper was flat at the end of the week. I think it was down a little and then picked up a little on Friday night, so it ended flat. Crude oil slightly lower on the week, 48.7. We've got this key resistance at $50, and that may well break now if the US dollar is heading back down again. There's the spot copper chart, so not a lot of change in the week in copper. So just to wrap it up, the overall strategic approach, look, there are several major triggers in June, and I've talked about them before, so I won't go back over those. Everyone pretty much knows what they are. So I think it makes sense, given that backdrop and given the uncertainties of these huge trigger points that we've got, and there's 4 or 5 of them, it makes sense to raise your cash levels, only from the standpoint that if we do get some sudden volatility and downside in the market, you really want to have some cash, because you can buy some great bargains and pick up sometimes 10 and 20% rebounds very, very quickly in the matter of just, a few days or a few weeks. But you've got to have the cash in advance to do that. Otherwise, you find you're having to sell things after they've just taken a bit of a beating, and that makes no sense. So you've got to have the cash before it happens. So that would be certainly one of my recommendations for the next few weeks. So I would expect turbulence, but we're probably going to break to new highs. And the reason that I say that is that there's really little incentive to sell. People are now coming around to the view that the being in bonds is a really bad idea. Hasn't been a great idea for some time, but the big gains that have been made over the last 3 or 4 decades in bonds are done. It's virtually impossible to replicate that. So the reason for being in bonds is not there. So where else do you go? People are pretty wary about real estate. So it only really leaves stocks and commodities, and hence there's a move into gold. But I just think there's no incentive for people to sell equities, because where else do they go with their money? And particularly now that we've got negative interest rates and we've got the possibility that banks may charge you to hold deposits, and all those sort of things are all playing on people's minds. However, the market, as I said earlier, the market is pricing in earnings growth in America of between 12 and 14%. That needs to come through by the year end. If we don't see that, then I think people are going to look at current valuations and say, well, they're just way too high. So that earnings growth, I think, is the key. Precious metal stocks, to me, this is the biggest opportunity that we'll see in the next decade. And for a lot of people, it will be probably the biggest opportunity perhaps of their lifetime if they've missed other opportunities. I really think the opportunity is that large and that likely that that's going to be the case. Short term, you need to be careful, because I don't know that this correction's finished. And longer term, as I've been pointing out, and this is really, really important, even though stocks may go up by 400 or 500%, as we see in virtually every bull market in gold, there will equally be pullbacks of 30, 40, 50%. So that is going to be extremely difficult for most people to negotiate unless you really know what you're doing. And I can't stress that point enough. Yes, fantastic gains ahead, but the volatility is going to be stomach churning. And for most people, they're going to need some help with that. There's my contact details for those that are interested in taking advantage of what I think will be probably the best wealth building opportunity of the rest of this decade. But for a lot of people, they're going to need some help. So there's my details. Would love to talk to anyone who's not a member. As far as members go, I'll be keeping you informed basically daily as this unfolds. That's it for this week. Cheers.